I am very excited that you guys clicked on this video today on how to invest for beginners because I have to say this one video, if you are serious about this, can truly change your life forever. And it's going to be such a powerful video that if you stay on this course that you've just started, it could change the generations of your family to come. That is how powerful of a thing investing is. So in this video, we're going to be talking about investing for beginners, but trust me, this video is not targeted at trying to keep you a beginner. I'm going to be teaching expert stuff, the stuff from the very best investors in the world, so that right from day one, you can start learning correctly. And that is the exact same course. This is the exact same path that you're on right now that I started back in 2018. And I started by reading one of the greatest investors of all time. He is still my hero, Peter Lynch. I think that he is the best teacher of retail investors, which I'm guessing you are. That just means the everyday man who also invests in incredible companies and assets. This is the teacher for you. And he was the teacher for me. And he allowed me to do something that I thought was absolutely impossible. You see, I started with just a few $1,000s in 2018 when I started investing, just a little savings. And I went from that to over a $700,000 portfolio just a little over 5 years later. I actually made my first investments in 2019. I was a little bit scared to actually jump in the market. But yeah, from 2019 to 2025, where we are now, I went from $40,000 to over $700,000. I have had the most incredible returns that I've ever seen. In fact, Peter Lynch, who is my hero, he averaged 29% annualized returns in the market. And trust me, once you start learning about compounding and stuff, 29% every single year is insane when you start to talk about decades. And yeah, my returns have been substantially higher than that so far. Although when you're starting with smaller amounts of money, it is quite a bit easier to get super big returns compared to once you get to like Warren Buffett's level where you're managing hundreds of billions of dollars. Then there's a lot less opportunity that actually moves the percentages up because you're just dealing with so much money. It's hard to get returns. But where you are and where I still am, where we're under $1 million, it is very easy to get incredible returns in the market. And we'll start going through this list. We're going to be covering preparing to invest, building a story so that you feel confident and comfortable and trust the companies that you're buying. The different stock categories, there's a lot of different stocks that you can invest in. We'll be talking about stocks to avoid, great company attributes, designing a portfolio, which is, I think, something that people probably worry too much about, and traditional finance education overcomplicates, honestly, most of these things a ton, and not to your advantage either. And then when to buy and sell, I will be sharing some thoughts on that as well. And my goal is that after you've watched through this whole video, you have a very good understanding about how to keep learning, how to start investing, and you feel confident that you actually can get outsized returns far better than you would get if you trusted your money with a Wall Street money manager who is likely to underperform even just owning the S&P 500. If you don't know what that is, that's just literally an index of the 500 biggest companies in America. And yeah, statistically, it outperforms like 83% of professional asset managers. And then you don't have to pay an asset management fee. So if this video overwhelms you, then I would say just throw money in the S&P 500. Definitely do not deal with Wall Street experts and do not listen to the Wall Street experts. One quote I really love from Peter Lynch is dumb money is only dumb money when it listens to the smart money. So yeah, stop listening to people on Wall Street. They think they're very smart, but their whole goal is to, take money from your pocket and put it into their pocket. And oftentimes they have ulterior motives about the stuff that they're saying on TV. Like when they get super bearish on something, they probably just shorted it beforehand or things like that, which means they bet against it. So if they make you scared and you sell your position, they make money. It's all that sort of stuff going on. Before we jump into the first point here, remember to drop a big thumbs up on this video. That would really help it out a ton in the YouTube algorithm. That's all I ask. I make these videos for you for free, so please drop those big thumbs up. And then if you're not subscribed yet, make sure you hit subscribe so that you do not miss any future content on how to make a ton of money in the stock market. Let's get to the basics here. So preparing to invest. Now, investing is one of the most powerful ways to build wealth in the world. It's more powerful than having a big income, than having big paychecks. Owning assets and letting assets compound over time is how you make money. In fact, the richest person in the world right now, Elon Musk, guess how much money he makes as the CEO of Tesla? Some of you guys will know this. Most of you probably won't. He makes $0. I think when they were in California, when Tesla was a California company, California had a minimum, so I think he made $1 a year. But yeah, he makes literally no cash compensation for being the CEO of Tesla. And then you might say, well, how is he the richest man in the world? Well, that is because he owns a significant chunk of Tesla stock. So he knows if he does good work and makes the company worth more, well, he will literally gain billions of dollars of net worth because his company that he owns becomes more valuable. And that is how you build wealth, not from big paychecks. In fact, some of the people that make the most money in the world, talking professional athletes, those sorts of folks who are literally bringing in millions, oftentimes they retire and they become poor very quickly. Because why? Well, they're spending all their money. If they were just investing half of those millions that they were making, oh my gosh, they would be so much richer in the later parts of their life than they were when they were a professional athlete. But the problem is, our education system absolutely fails us and does not teach us how powerful investing really is. But if you want to invest, then you need to understand that this money that you're investing, you cannot touch it for a while. You have to have a little bit of the skill of delayed gratification because yes, it is still your money. Yes, you are still going to be able to use it in the future, but the stock market, it can go down a lot in the short term. In fact, there's crashes of 10% or more very often. Every couple years, you have these drawdowns of 10% or more. That means that if you're investing money that you're planning on using in 3 months, that's a really bad idea because it is impossible for anyone to know how the stock market is going to move in the next 3 months or even the next 6 months or even the next year. But what you can know as an investor is that as long as America and humanity continues to develop and progress, which we have now been doing for thousands of years, and we don't do anything to eliminate ourselves, then the market is going to go up over the long period of time. It's just important that you understand that this is money that you are planning on multiplying over the 5 and 10 year period. If you want to get rich quick, you're not going to get rich. You have to be willing to get rich slowly. That's how you're going to make a lot of money in the stock market. So if you're here and you're trying to make money for 2 months from now, this is the wrong video for you. Watch some trader who's going to show you some voodoo and maybe you'll get lucky. Maybe you have like a 45% chance to actually do it. But if you want to know how to make a ton of money, not small cash, I'm talking millions and millions of dollars over the long term, and be able to retire early and do whatever you want, to be able to benefit humanity through donations, to be able to set up your kids or your relatives, like this is the video for you. But this doesn't happen over a couple months. This happens over a couple decades. So when you're preparing to invest, 2 things you need to know. 1, invest money that you don't need in the short term. And 2, you need to understand the market goes down. And that's okay, because over the long term, the market goes up and it goes up a lot. Thousands and thousands of percent. So now let's talk about number 2, building a story. So building a story in the stock market is really important because you have to understand that you own actual companies. We've already mentioned this. You can own McDonald's, you can own Coca-Cola, you can own Tesla, you can own Apple, Google, Microsoft, all of these companies that I'm sure you've heard of. You can literally become an owner of them. But it's important that you actually understand what you own and you have a story in place so that you can explain why you own a company. And if someone asks you why you own a company and your answer is because it's going to go up, then you don't have a story. You don't really understand why you own this company. So, for example, the first story that I ever built and the first company that I ever invested a substantial amount of money in was back in 2019. I put almost all of my money. In fact, there was a small period of time when the COVID crash happened in early 2020 where I actually moved all of my money into Tesla stock. Now, I would not recommend being all in a single stock. In fact, I don't recommend it at all. I think that you need to at least own 2 or 3 companies minimum, although I don't think you actually need to own much more than 2 or 3 companies. Also, as an individual investor, it's not really that easy to have an incredible understanding of more than 2 or 3 companies. But during this short period of time, I had built a story on Tesla that I was so confident in that I was willing to put all my eggs in that one basket. So what does it mean to build a story about a company? Well, it means you understand kind of where it fits in the economy, where it fits even in the story of humanity. Not all companies are doing something that big, but Tesla happened to be doing that. And then to understand different factors that are likely to set up the stock that you're buying to have outsized success, far more success than anyone sees coming. So at this period of time, Tesla was just barely getting to the point where they were starting to actually make a profit. All the time before 2019, 2020, Tesla was losing money on every single sale. And in fact, Tesla was one of the most shorted companies in the market because much of Wall Street were betting that they were going to go bankrupt. And guys, don't get bored about this. This is important to kind of, you'll hear these connections and you'll be like, okay, that's what I'm looking for when I want to make my own story. So let me just go over just one thread of this story that made me so confident in it. And this thread was that the single biggest cost of making an electric vehicle was the battery cost. In fact, for most of Tesla's history, the battery cost was like 1/3 or even more of the cost of the vehicle. So it's a huge percentage of the cost. Now batteries are a much smaller cost, but what I saw was that battery costs were declining at a very consistent rate. For 5 or 10 years straight, you could just see this chart of battery costs declining. And I was like, wait, the battery cost is the single biggest cost in making a Tesla. It's declining at this incredible clip. I think it was declining at like 35% a year or something around there. It's been multiple years since I've looked into this, but it was pretty substantial. When you're cutting something by even 30% a year, it starts to get a lot cheaper very fast over 4 or 5 years at 30%, 30%, 30%, 30%. It's just, this is cheap. And I can easily see if battery costs were declining this fast, they were the single biggest cost in a Tesla, that pretty soon the cost of manufacturing the Tesla was going to get low enough. The Tesla was actually going to start making a profit, and it was going to be a substantial profit at that. Because guess what? Even after they broke into profitability, those battery cost declines are just going to continue. And then the other thing was that Tesla was on the cusp of releasing the Model Y, which the Model 3 was very successful. People loved it a lot. And I thought the Model Y could be even bigger than the Model 3. In fact, I remember telling my parents, I think this car might become the best-selling car in the world, which sounded crazy at the time. And lo and behold, now it is the best-selling car in the world. And what ended up happening was the Tesla purchase that I made, I put $40,000 into it, all my money in the beginning of 2020. And it 20x. It 20x from the bottom of the COVID crash, which I got pretty lucky. I wouldn't recommend, I don't think you can consistently time stuff, but I got pretty lucky and almost bought Tesla at the very bottom of the COVID crash, which had a V-shaped recovery, which just means it like crashed down and then went pretty much straight back up. And Tesla 20x. So a 10x would mean going from 40,000 to 400,000. A 20x means going from 40,000 to $800,000. And this happened in about 2 years. Now, I did not sell. I, in fact, held Tesla all the way back down, and it crashed super hard over the next couple of years, and back to like a 5 or 6x or something like that. So I had this massive roller coaster. I was still learning a lot. I still only owned one company. At a certain point of valuation, I knew Tesla was expensive, but I still didn't diversify my portfolio at all. Because I was like, well, long term, it's going to get a lot higher. And I think I'm right. Long term, it is going to get a lot higher than the peak. In fact, we just surpassed the peak once this year, 5 years later almost, than that peak that we hit on that initial run. And I actually did diversify quite a bit on this next time that we hit the peak. But that just goes to show I built a story in my head. I understood that legacy auto, their prices hadn't been declining for several decades, really, and that electric vehicles were getting way cheaper to produce every single year. And that was simple enough to put together a story of going, hey, Tesla's going to start dominating. And I got lucky that it happened so quickly. It was even far greater than I could have imagined, the run-up that happened. But that's all investing is. Seeing a story, understanding how things are going to change, understanding how that's going to impact the profitability of the company that you own, and then letting it all play out. And one thing that you should know is that in the short term, this is honestly part of preparing to invest, but also it ties into building a story as well. In the short term, the market is entirely a voting mechanism, which means that people vote on how excited they are about a company or how disheartened they are about a company. And prices can fluctuate crazy amounts in the short term. But you can't let that rattle you. You can't let that get to you. And it's a lot easier to say that than to actually do it, because it's a gut check. Investing is not really about being really smart. It's about having a strong gut. Because when everyone is voting against, when everyone is afraid, when I was all-inning on Tesla at the bottom of the COVID crash, it was fear everywhere. The whole economy was shutting down. Like the Tesla factory was literally staying shut down for months and months and months after I bought it. Like this was a scary period of time. People thought that we had a virus coming that might wipe out like a huge percentage of humanity. It was fear and pandemonium in the streets. But I just understood my story. I was like, I can't control if humanity survives or not. But I think the story is going to play out if humanity does survive. And that's when I bought. So there's going to be times when wars are breaking out, when people are scared and running in the streets. And those are actually some of the best times to buy, which we'll talk about that in when to buy and when to sell. But in the long term, and this is why you can be confident, this is why you can kind of let that fear and pandemonium, and on the other side, let the FOMO, the fear of missing out, the extreme greed, you can also let that pass you by. Because you know, in the long term, the stock market is a weighing mechanism, which means the actual weight, the actual value, the actual profitability and free cash flow of the companies, that is going to be what determines their value in the long term. So in the short term, yeah, stuff can fluctuate a ton, but in the long term, the stock market eventually is a weighing mechanism over the decades. And you can follow a company like McDonald's free cash flow and see how much it goes up over 20 years. And then you can look at the stock price and it will be almost identical. And that is the same for every single company. Over the long term, the stock price follows the growth in their free cash flow, which is how much cash their business is printing after all expenses. That's what investors really care about. And that's what's going to determine value long term. So finding good companies that are going to grow their profitability, that is how you make money over time. Okay, so we talked about preparing to invest, building a story. You can literally like come up with the first threads of a story anywhere. Walking through a shopping mall, looking at Amazon, seeing what the best sellers are, seeing what people are talking about on TikTok. What product do you like? What product does your family like? Like that is enough to start to like make the curiosity peak and then dive into that story. Another example, this is actually like an example of how I found a stock, and then also I just didn't choose to buy it at the time. I'm actually thinking about buying it around now. Was Celsius Energy. I noticed my younger brother was drinking Celsius all the time, and I had never seen the drink before. I was like, well, what is this? He's like, oh, it's this new energy drink. It's great. Everybody loves it. So I was like, wow, that's really interesting. Is this a public company? And I found out, oh, wow, it is a public company. And based off of how much my brother liked it, I tried it. I thought it was pretty good. I was like, I need to research this company. But lo and behold, when I started looking into it, the stock was super expensive. It had run up a ton. It was trading at, I think, several hundred times earnings, which means that literally to buy it, I had to pay several hundred years worth of the last 12 months earnings. So if you look backwards, how much money did they make in the last year? Okay, to buy this company, you have to pay 200 times that what they made in the last year. And that is very expensive. And paying too much for a stock is definitely one way to lose a ton of money. Peter Lynch, he actually talks about how when you're looking at growth companies, and we'll be talking about stock categories in a second, when you're looking at growth companies, you want to try and find a company that has growth that is higher than its price to earnings ratio. And price to earnings is just what I was just mentioning. It's the price you're paying divided by the earnings per share. So price per share divided by earnings per share is the PE ratio. So if you're paying $10 for the share, the earnings per share are $1, then that means you're paying a PE ratio of 10 times earnings in order to buy that company. And the stock market, like if you look at the banks and stuff, a lot of banks trade a little over 10 PE because it's a very stable business. It's not growing that much. And you own it. It takes you 10 years of earnings, and now you've made back your initial investment. And guess what? You still own the company, so you can keep making 10% every single year. That pays you better than if you own a bond. I don't like bonds. This video is not about bonds. We're not going to get into it. But yeah, even buying a company at a 10 PE with no growth means you're getting a 10% return every single year because you're getting 1/10 of your investment back every single year in company earnings. And that money is going to come to you either in the form of dividends, stock buybacks, investing into future growth, something like that, which is going to benefit you as the shareholder. But if a company is trading at 200 times earnings, Peter Lynch would say in order for that to be a good investment, it has to be growing earnings more than 200% every single year. Because you need to get a lot of growth in earnings before that PE ratio gets to a reasonable level and for you to actually make a decent return. So Tesla right now is trading 130 times earnings. So if you ask me, is Tesla like a really good investment right now? I would actually say it's a bit on the expensive side. I'm not going to lie. 130 times earnings. I do think if you're going to own it for 10 years, you're probably still going to make a lot of money. But the fact that it trades at 130 times earnings means it can fluctuate a ton. There's a lot of leeway. It's entirely based on investor sentiment and future investor predictions. So if the autonomous taxi network works, if Optimus bot works, if energy storage really grows to be as big as their auto side of the business, if they release a new vehicle that's much cheaper than the current ones and they can grow deliveries a ton, then yes, eventually they're going to bring that down and grow a ton. They'll grow into that valuation and they'll probably grow much larger than that. But the current price is not cheap based off of current earnings, and you need to understand that. So there are companies in the market. So Celsius, let's go back to it, then crashed a ton. I'm so thankful that I did not buy it. There was a bit of fear in the market. What happened was Celsius signed an agreement with Pepsi. And as I'm going into this, guys, just know you can learn these stories for all of the companies that you want to invest in, and you should know them. So Celsius had just signed a big deal with PepsiCo, and PepsiCo was going to start stocking Celsius where they with their other products, and bought a ton of Celsius, and it made Celsius sales look even better than they were. So they had this insane growth. PepsiCo was buying all the Celsius they could, and the growth of Celsius revenue was insane, and it maybe looked like paying 200 times earnings was a good deal. I mean, this stock was growing it was doubling year over year. Peter Lynch would still be skeptical if it's only doubling and you're paying 200 times earnings, because that's only 100% growth, right? But yeah, it looked insane. But then what happened? Well, turns out PepsiCo had been over purchasing Celsius. PepsiCo couldn't actually sell all the Celsius as fast as they were purchasing it. And they ended up realizing they had too much inventory, and they had to stop purchasing from Celsius until they cleared out their inventory. So all of a sudden, Celsius in an earnings call gets up and they're like, hey, PepsiCo bought too much from us. They're going to stop buying for a couple quarters until they clear out their inventory. And you have these massive down quarters in Celsius sales. And now all of a sudden, you have a stock that's trading 200 times earnings and shrinking. And that is how you get these insane pullbacks, where I think Celsius is now down like, I don't know, somewhere between 70 and 90% over its peak. Now I am interested in buying Celsius, actually. It's a stock that I'm curious about. I still haven't pulled the trigger on it. I just don't really understand if they have a moat, like what actually separates one energy drink from another, like what really gives it a defensible position. It has to be taste, right? Like that's how Coke dominates. Coke also has like local manufacturing in all these different countries, which keeps their costs low, all this stuff that's really smart. But I was like, I don't know, like it's easy to see battery costs are coming down. That's going to lead to a ton of profitability and an electric car sale. It's hard to know what really is going to guarantee an energy drink company is going to keep on growing a ton into the future. But I'm sure a lot of you guys know more about energy drinks than me. So if this is something you know a lot about, then Celsius might be something you should look into. And maybe it is a really good deal right now, and maybe I'll miss it. I definitely miss more stocks than I get. And if Celsius can return to anywhere close to the growth rate that it had before, now that it's been revalued down a ton, it's probably going to return pretty good. The most important thing about building a story and about investing is that you're investing in things that you know. Don't invest in things you don't know. It doesn't matter if it's the next thing from sliced bread. It doesn't matter if everyone on YouTube is talking about it. If you don't understand it and you can't grasp your head around it and the story is not clear to you, then don't invest in it. Invest in stuff that you understand. Invest in things that you know how to keep tabs on as well so that you can continue following the story. That's the most important thing. Build a story that you can follow, build a story that you can understand, and stay up on that story. Okay, stock categories. So we're just going to go over this really quickly. There's a lot of different stock categories. I think most people who are new to investing, Peter Lynch as well, who is an expert, I myself tend to lean towards these sorts of stocks. Growth companies, that's one category. Growth companies are companies that are growing their earnings between 20 and 50% a year. Some people would call a company a growth company if it's like 15, if it's over 10%. But I like faster growth companies. So yeah, growth companies, these are companies normally you have to pay a little bit of a premium for because they are growing quickly. So there are several years of growth already priced in, which means you have to be confident they're going to continue growing long into the future, even beyond the couple of years that are priced in. And you have to be willing to hold a growth company over the long term, because growth companies are oftentimes the most volatile in the short term. Because remember, it's a voting mechanism in the short term, and people's opinions, people's emotions change a lot. And when to buy these is like when the expectations are the lowest is actually the best time to buy. So, for Tesla right now, expectations are pretty low. Growth's only expected at like 12%. So maybe that could be an argument for why it could be a good time to be buying more Tesla, even though the price is expensive. If you think the 12% growth is accurate, though, then it's way overpriced. Another stock category is like a value stock. So this could be, like I was talking about banks, a company that's not growing, but it's just priced so cheaply that you're going to get good returns out of it. For example, there are some stocks right now in the market that are trading like 5 times trailing earnings. That means they like per share, it costs $5 to buy them, just for example, and they're making $1 in earnings. That means it only takes 5 years before they have made back the full price that you paid. That is a quick return. You're getting 20% annualized returns instantly off of that with no future growth, just because you're only paying 5 times earnings for it. That's pretty crazy. How do I get 20%? Because if you do 2, 4, 6, 8, 10, 5 years to get your whole 100 back, so you're getting 20% annualized returns if you buy something at a 5 PE. So value stocks like that, as long as they're not shrinking, you still build the story for them. You still understand, okay, yeah, they're going to keep printing money for the next 10 years. Like, you still need to know that for certain. But what's nice about value stocks is you don't actually need growth out of them in order to get your return. And oftentimes if a stock's trading at a 5 5 times earnings that you're getting a 20% annualized return. Like, investors are greedy. They should not let that stand for too long. The stock should get repriced and you'll probably get an instant double out of it, or, over the next period of time. As long as the company's not headed towards bankruptcy or shrinking a ton or something like that. It should probably trade closer to 10 times earnings. So at least then it's not that crazy. And people who are buying it are only getting a 10% annualized return. So then, you get a double and you can still own the company over 5 years and you're getting all your money back. So that's pretty great. Another type of company is a cyclical. So auto companies are cyclical companies. Chip manufacturers are cyclical companies. These are companies that sell a product that tends to go through boom and bust cycles. So one of the reasons why auto manufacturing is a cyclical company is because you go through these interest rate cycles, and the interest rates affect the buying price of a car a ton. Because when people are looking at what sort of car they can afford, they're looking at whether or not they can afford the monthly payment. And that's the most important thing. And the monthly payment is based off of the loan and the interest rate. So if you buy, just to make the math easy, a $100,000 car, and you have only a 2% interest rate on that, and let's say you borrowed the whole 100,000, well, then you're paying an extra 2,000 a year in interest. So that increases your monthly bill. That just the interest increases your monthly bill by 800 or several hundred dollars, like $150 or something a month, right? Because if you had to pay $1,200 in interest, then that would be an extra $100 a month. So you're paying, $2,000 in interest. So you're paying almost $200 a month extra just for the interest. But then what happens when the Fed raises interest rates to 6%? Well, now you're paying $6,000 in interest on that loan every single year. That drastically increases your monthly payment amount. You're paying, $500 a month now in just interest, let alone actually paying down the car. So I'm just saying, when interest rates go up, the price of buying a car goes up a ton and car sales plummet. And then once you get into the rate cutting cycle, which we're kind of in right now, starts making cars cheaper, sales start going up. So you get a cyclical business with these booms and these busts. So cyclical companies, it's important to know what sort of company you're buying when you're creating the story, because you don't want to own a cyclical company right at the peak of a boom cycle, right before a massive bust, because then you're going to end up losing a ton of money. However, if you understand, hey, we're in a bust cycle, a boom is coming, then that might be part of your story about why it's a good time to buy some of these companies. Another example of a cyclical would be the chip makers like NVIDIA. NVIDIA and AMD, they both got a ton of increased valuation when companies like Amazon, Microsoft, and Google were building out cloud storage for their cloud hosting businesses. They were just building out all of this infrastructure, and these stocks went through a boom cycle. And then they went through a bust cycle afterwards, and they were kind of down and out. And there was a period not too long ago before this new AI boom cycle started where NVIDIA and AMD were very cheap stocks. They had crashed a ton, and you could pick them up at pretty good prices. And if you knew, hey, this is a cyclical company, there's probably going to be another boom cycle coming. I mean, maybe you couldn't have predicted AI, but you could have predicted that we're in a bust cycle, so it's probably going to get better from here. And you could have made a ton of money on this new AI boom cycle that we're in. Now, guess what? There's going to be a period. I don't know if it's next year. I don't know if it's 3 years from now. I don't know how long it will be, 5 years. But there'll be some point where companies realize, wait, we've built out too much AI infrastructure maybe, or we built out too much training and we need more inference, or however it is. And they're going to stop spending as much money as they possibly can, which is what they're kind of doing now, to try and build the biggest AI computers that they possibly can. And we're going to go from these chip makers being in the super boom cycle to there's going to be another bust cycle. And guess what? That bust cycle is probably going to be another good buying opportunity, because there's going to be another boom after. You better believe it. So cyclical companies. So we covered growth companies, value companies, cyclical companies. And value can also come in a form of a stalwart. Stalwart is a term that Peter Lynch uses, and it's really a company that's kind of at the end of the growth phase and is now kind of it's stalling out a bit. It might still be growing a little bit, But that is a category of company as well, where it's like, okay, they're established, they've become mature now, they're not really growing much anymore, but they still might be a good company if you can get them at the right price. All right, stocks to avoid. So there's many things that are huge red flags when you're thinking about buying a company. And these are things that you need to learn to look out for. One red flag that I like to look out for is a company that has way more debt than they have assets. So you need to look at companies' balance sheets. Buying a company with way more debt than assets means that you're actually paying a lot more for the company than it looks like on the stock price. For example, if a company has a $10 billion market cap, so you think that you're buying the company for $10 billion, and just know you with a $10 billion company, if it has 10 billion shares as well, then each share is only $1, so you can buy just one share. But if you think you're buying a $10 billion company and it turns out that they have, say, 2 billion in assets and 22 billion in debt, well, guess what? That 22 billion in debt, you back out the 2 billion in assets, and now they just have 20 billion in debt. Well, now the enterprise value, the EV, enterprise value of the company, is actually $20 billion. And now you're paying $10 on top of that. So you're actually paying $30 billion for this company. The enterprise value is now $30 billion because it's $10 billion for the price of the stock, $20 billion in debt that you're also buying. Because guess what? You're buying that debt, and now that debt's yours. Congratulations. And the company can be way more expensive than it looks like. Plus, if a company has way more debt than assets, then it can go bankrupt. There's a bankruptcy risk there. And the way that you lose all your money in the stock market is if you buy a company that goes bankrupt and doesn't exist anymore. And if there's a ton of bondholders, if there's a ton of debt holders, guess what? All the debt holders, they're going to get all that, whatever money might exist, they're going to get it. You as a stockholder, you're not going to get anything. However, the great company attribute would be the opposite of that. You look at the balance sheet and you realize, hey, wow, this company, so there was a time in this recent class in 2022 where Robinhood, the stock trading app Robinhood, was actually trading below their cash value. So just for example, say the company had $1 billion in cash, you could buy the stock for 800 million, for example. So the stock was trading at 800 million and they had $1 billion in cash and no debt. So that means that you're literally buying dollars for 80 cents. You're literally buying dollars for 80 cents. Plus, well, what did Robinhood end up doing? So why? First of all, why would a company be valued like that? Well, because it's being valued like it's going to burn up all that cash and then it's going to go bankrupt. So people are like, I don't want to buy this dollar for 80 cents when the company that has the dollar is going to waste it and then go bankrupt. So that's kind of what the market's thinking. But guess what? Robinhood didn't do that. They ended up, getting to profitability, growing a ton. And if you had bought that 80-cent dollar, you had crazy returns. I think you might have almost 10x or something from the bottom over a couple of years. So I'm just saying, like, these misprices in the market, they happen all the time. So that's something that you want to look out for as a good attribute. If a company has a ton of cash and no debt, or just way more assets than liabilities, well, then guess what? You're actually paying less for the stock than it looks like on the market cap. Because to get the enterprise value, you do stock price plus debt minus assets. So if a company is worth $10 billion, for example, and they have $5 billion in cash and cash equivalents or long-term investments, or maybe that's just their full asset amount, and they have no debt, well, guess what? You can now buy this $10 billion company for $5 billion. Because you buy it for $10 billion, and guess what? You're buying $5 billion in assets with that $10 billion purchase. So half of that price that you're paying is literally just in assets that are worth that $5 billion. So then you're really only paying the $5 billion remaining to own the company and get all the upside for what they do with those assets, all future growth, all of that sort of thing. So the balance sheet is really, really important. Another thing to avoid is a company that's losing a ton of money and doesn't have a clear path to get to profitability. There are a lot of companies that are growing very fast. They look very attractive because they're growing fast, but they're losing money on every dollar that they make. And let me tell you, I've done this before. It is very easy to sell, $2 for $1.50. Like you can grow so fast if you're willing to sell someone $2 for $1.50. But you're losing, 50 cents on every $2 sale, which is a negative 25% margin. And it's very easy to grow with a negative margin. I did e-commerce for a while, and I had a 3-month period where I did $800,000 in sales. I was so excited. I was like, this is amazing. E-commerce is easy. Until I realized my expenses for that $800,000 in sales was $950,000 after accounting for cost of goods, shipping, returns, employees, all the stuff. And yeah, I made a lot of sales and lost $150,000 on my $800,000 of sales. That's bad. You want to avoid stocks like that, because I could have said, 5,000% growth. I have 5,000% growth and I'm going to keep on growing. All that would mean is I'm going to keep losing more and more money. So if a stock's not profitable, you have to understand in your story how they're going to get to profitability. Like with Tesla, I knew battery costs are getting cheaper. They don't have to change anything except keep building cars now with one of the biggest, expense of the whole vehicle gets less and less, and they're going to start making a profit. So avoid stocks with a lot of debt, avoid stocks that are losing money, that don't have a path to become profitable. Another thing is avoid a stock that's being completely innovated against or disrupted. That's the word I was looking for. For example, right now, General Motors, it looks cheap, but they're being disrupted because gas cars are not getting cheaper. Electric vehicles are getting cheaper. Electric vehicles are a lot better. They're way more fun to drive. They're way faster. You're literally driving a computer. It can drive itself. All these advantages that gas cars don't have. GM is getting innovated out of existence. You want to avoid it right now unless you know something I don't and realize that they have this clear plan to make these incredible EVs that they aren't going to lose a ton of money on, which Ford was losing like $1 million per electric Ford sold. So they kind of pulled back on that. Avoid stocks that are getting innovated out of existence as well. Okay, so great company attributes it's like the opposite of these. If a company is innovating a ton, like Tesla, for example, or another company I really like is Lemonade. They're building a whole AI insurance company, really, that everything is automated, from determining if there's a fraud claim, signing up new customers, responding to customer support emails. Like they're trying to automate the entire thing, which is going to make their costs so much lower compared to incumbents. That's a great company attribute. Way more cash or assets than debt, great company attribute. Another thing I really love for a great company is a company that's still run by its founder. I love founder-run companies, especially if the company worth over $1 billion and the founder's still running it. That's juicy. A founder understands their company better than anyone else. They understand where they want to go better than anyone else. I love that a lot of founders are literally like high school and college dropouts, which I love. Trust me, they are way better than the Ivy League graduate business school graduates who just joined this company at the top, and they can do okay. They can do okay. Many have excelled. There are some incredible CEOs that do come in that way, but the vast majority of these founder CEOs, especially if they're still CEO of a company they founded that's worth over $10 billion, their returns compared to the overall market are insane. And oftentimes, most of the story that I get most confident about, that makes me like really excited about a company, is when it's a founding team, 2 co-founders or a founder, some leadership that I just really believe in. Like maybe I was watching them at another company and I just saw that they were just killing it. They just grew that company so much. And then they joined this company and I'm like, oh my gosh, what are they going to do with this company? Like that could be a reason to really look into that story, just because a couple of people you like move to another company and are going to be doing good stuff there. So a great company has great people. I mean, what is a company? A company is literally a group of people that have a single goal that you like. A great company is going to have like a really great mission statement that makes you believe in them. And yeah, a great company is going to execute. So like one thing to avoid is if companies make all these promises, and whenever you're learning the story of a company, it's really good to listen through some of the earnings calls. You can just find them on YouTube or on the investor relations pages of any company that you're interested in buying. If a company is making a ton of promises and then missing it all the time, so they're constantly like saying this is what we're going to be doing next year, and then they come in below that, or they're like 5 years ago they said this, and now they're saying something way lower than that for their 2027 trajectory or something like that. Like, you want to avoid that. But a great company makes these promises and beats it, and then they make these promises and they beat it, and that's the sort of company that you really want to own, because they're just going to keep beating expectations. People don't change much. Every once in a while, something will come out of the blue and they'll miss. That's okay. But for the most part, if a company continually under promises and over delivers, if that's what leadership does, they're going to keep on doing that, and you can trust that they're going to keep on doing that. Okay, so we're almost to the end here. So designing a portfolio, I would just really say it's good to have at least 2 or 3 companies. Warren Buffett actually says you don't need to own more than a couple of great companies in your life to do very, very well, and I 100% agree with him. I really believe that if I had bought Tesla in 2019 like I did, and I never sold it, and I never did any other moves at all, I would greatly outperform the S&P 500 and all professional money managers throughout my entire life. I think I could have made that one decision, never made another decision again, and I would have been completely A-okay with these godlike returns that just no one could understand or believe by making one decision and owning a single company that's generational. So I do think that is possible. However, it's really nice to own at least 2 companies, because then you can take advantage of when the market is going insane. So when the market is going insane on the upside, like way too bullish, pricing in way too much future growth, well, guess what? You can sell some of that company and move into your other one that's maybe not so overvalued. Or on the other side, if a company is being treated like it's going to go bankrupt, or is like the worst company in the world, and that's not true, they're going to bounce back, well, guess what? Because you own more than one company, you can sell out of the one that's not being priced super below its intrinsic value, and you can buy some of it with some of the funds in your other company. So just having more than one company gives you some optionality, as long as you're not, putting more in every time something's up and then selling when things are down. That's the opposite of what you want to do. You want to understand the stories so that you can buy the dips and you can sell the runs, if the run moves it to a place where it's overvalued. Sometimes the stock doubles or triples and it's still undervalued because it was just so undervalued before. So you just need to understand. You need to understand what ratios it's trading at and whether or not that's expensive or cheap. And I'll do a whole video on ratios before that, but the main ones are price to earnings ratio, which we've talked about, price to sales, which is revenue, not earnings. So revenue is top line. Earnings is what's still left over after all your expenses in between. So price to revenue or price to sales, revenue sales, the same thing. That's one metric. Price to earnings is then an even more important metric if a company is already profitable. Price to book is a good metric. It's the price you're paying compared to the value on that company's balance sheet. So book value can be negative. Remember, if a company has more debt than assets. But oftentimes, for a bank, you're just paying a little bit more than 1 or 2 times book value for the bank. Banks trade quite cheaply. So yeah, own 2 or 3 companies. And then I would also advise, and this is really the only other thing that I think that's super important for designing a portfolio, is try to make sure they're in different sectors. Because, for example, if they are both automakers, and auto manufacturing is a cyclical industry, remember, and the market goes into a cyclical downturn, well, guess what? Both of your companies, because they're both making cars, they are both going to get hit super hard. And then you're going to realize, oh, I thought I was diversified, but I'm not diversified at all. Whereas if you own a car company and an insurance company, or like Google, a search company, and I don't know, Uber, which is a ride-hailing company, it's like they're very different. They're in completely different industries. They have different customers. And even though if the whole market goes down, they probably will both still go down. They're not going to move together in the same way. They're going to be uncorrelated assets, and you're going to find more opportunity for arbitrage if one industry is down a ton and the other one's not, or vice versa, something like that. So yeah, I would say a minimum of 2 stocks, probably 3 is good. I would say don't go over 10. Don't go over 10. Once you get more experienced and you have a track record and you know these companies really well, and you find another company, you're like, oh, I really want to own this 11th company. It's incredible. Okay, well, that's different. I think it's okay. You don't need to arbitrarily limit yourself. as long as you really know the story of all of them. And Warren Buffett has said this a lot. I think Peter Lynch has said this, but I think it's so true. There's no reason to put money in your 11th best idea when you can just add more money to your number one best idea. Because guess what? You're going to make way more money off your best idea than you ever do based off your 15th best idea. It's just the way that it's going to be. So I think that the traditional investing education, Peter Lynch would agree with me. Warren Buffett would agree with me. Charlie Munger, when he was alive, would have agreed with me. You can find videos of him saying this. Traditional finance teaches you ridiculous stuff. So many things that just don't add value, way over diversification, which turns into diversification worse. It makes your portfolio worse when you have hundreds of stocks you don't understand. And just keep it between 2 and 10 stocks, especially as a beginner. And I think you'll find the most success. Also, when you're dealing with small amounts of money, having $100 in 100 different stocks, you're never going to make anything. Like, really. Whereas if you put that all into a single stock, like I did with Tesla, with just a couple 10 grands all into Tesla, and all of a sudden it turned into $800,000. Like, that's insane, which would not happen with a diversified portfolio. Because if I was diversified into 100 different stocks, all I would have had is like 500 or maybe 1,000 into Tesla max. And a 20x on 1,000, guess what? That's only $20,000. It would have barely moved my portfolio up 50%, even though the stock 20x, which is not something that you want. So don't become overly diversified. If you know what you own, that is far more important than trying to mitigate risk by owning everything, because then you're going to own a ton of bad companies. You almost made it to the end. If you guys have been enjoying this, remember to drop a big thumbs up and subscribe if you're not subscribed already for more content like this. When to buy and sell. We've already talked about this a bit. Buy when you know the story is really good and the market hates your company. And sell when the market is over exuberant, when your CEO is on the front page of magazines and everyone is saying all the things that you know about the company and pricing in all the things you know. Well, guess what? All that future growth's been priced in now. That's when it's time to reduce your position and move it into some other things that aren't getting as much glory, that aren't currently the stock in the sun, so to speak. Because when you're at the top, guess what? The only thing that can happen now, when everyone's talking about a company that you own or everyone's pricing in perfection, it can only get worse from there. Really, it can. People will start talking about it less. Something will happen. People will turn. And oftentimes you'll be able to buy back in even cheaper later on, if the story is still good, if the valuation goes down a ton. Thanks so much for watching How to Invest. My name is Jacob. I've been your host today. If you enjoyed it, and I hope to see you next time.